Hello and welcome, everyone. It's our fifth podcast of 2024 of It's Your Life. My name is Paul Zimney. I'm a CPA and a licensed health and life insurance consultant in St. Louis, Missouri. And together with my partner, ShannonCarpenter, we are going to discuss today mortgage protection life insurance. In other words, how to protect the most important investment of your life. Our goal, as always, is to help you improve your life, your family's life, and your legacy. So without further ado, I'm going to turn it over to Shannon for a couple of quick comments before I get into the nuts and bolts here.
Well, buddy, I'm just excited to learn a little bit from you. I do mostly the retirement side of things, annuities and IULs and infinite banking. So I'm excited to learn a little bit about mortgage protection and possibly equity protection. So you go right ahead and I'll make some comments at the end.
Okay, so for most people, their home is the biggest purchase or investment they'll make in their lifetime. And it's also generally the largest loan they'll ever have in their lifetime. So how do you protect this investment and mortgage in the event of an unexpected death? Okay, that's the question here. Two primary ways to use a life insurance product to provide this needed protection. First is using a term life insurance. So that is a great way to protect your home, your mortgage, and the equity in your home. As many people are not aware, the contract you make with a lender when you take out a mortgage with a bank, the contract is that they are going to provide you a big chunk of money so you can add that to your down payment and purchase a home. All right. The second part of the contract is that you agree to make a monthly payment to them for a long period of time, generally 20, 30 years. All right. So that's kind of the contract trade-off there. If something happens and you cannot make those payments anymore, the fine print in that mortgage contract says that the bank has the ability after a short period of time to foreclose on your property, take your property, liquidate your mortgage, and also assume the equity in your home. And that would be a very bad thing to happen for any family, right? So let me use an example here. So let's say you have a $300,000 home, you have a $250,000 mortgage, okay? That means you have $50,000 of net worth in that property. If the bank were to take that property over at some point because of non-payment, then you would lose literally $50,000 of equity in that home. So how do you protect that? You can get a term life insurance policy if you qualify to cover all or most of the mortgage. You could apply for a $250,000 term policy, or some people will apply for, in that example, 200, or maybe they can only afford 150, but they want to protect the majority, if not all, of that mortgage. This approach is especially affordable for younger couples who are in good health and may have a greater need due to higher mortgage balances, young children still to raise and get through school, and depending on one or more working parents' income. Okay. Now, there's a second approach, and that is utilizing whole life insurance. Okay. This would be used more in situation where the homeowner may be older, may be on a fixed income, may not be in a position to qualify or afford a larger term life product. Here's an example. Let's say someone had a mortgage of $850 a month, including taxes and insurance. And then you add up all the utilities, the electric, gas, sewer, water, etc., and that's $350 a month on average. So the total cost to operate that home is right around $1,200 a month. Okay, so then the question is asked, well, if someone, the individual or one of the married couples, if they were to pass away suddenly, the question is, how much time would the surviving spouse need or want to have the home cost paid for without having to worry about it, without having to negotiate with the bank, without having to borrow money from family members or dip into needed savings. And so to use that example, let's say they wanted 6 months covered. Well, that'd be $7,200. 12 months, $14,400. 18 months, $21,600. So maybe the person there agreed that they want close to 18 months where their surviving spouse would be able to have all of those home costs covered and make the necessary decisions, whether they're going to stay in the home, whether they're going to sell the home, potentially move in with other family members, etc. So we'd look at, say, a $20,000 whole life policy, which is going to be, more affordable, especially if you're older, and easier to qualify for. So basically, there's two approaches in conclusion, two approaches to protect your mortgage, your investment, and your equity. And that would be the term life approach, generally, again, for younger couples, maybe, and then the whole life approach. But they both accomplish a similar goal as we discussed. I hope that helps. Shannon, I'll turn it over to you for some concluding comments here.
Sure thing. That was good stuff, Paul. I have agents that sell plenty of this, and it's kind of funny. We talk about mortgage protection, which really is just a term policy. So, we've had people call in and, we say, oh, you're looking for term. They go, no, I need mortgage protection. Like that's what that is, right? It's just a different word that we use basically to market that product. But the equity protection is one of my favorite things you said, because it gives the spouse time to make that decision. Because when you've just lost a loved one, emotions are high. We're very vulnerable. We're stressed out. We don't need to make any rash decisions. And if the spouse, let's say the husband passed away, if the wife can't afford all those bills after they miss 3 or 4 months worth of payments, somebody's coming to take that house, and that's the bank. And if you have, like you said, I think you said a $300,000 house, and let's just say they owe $150,000, they have $150,000 of equity. So when you say equity protection, I think that's genius, because even if you only do a $20,000 whole life policy, if that's all they can qualify for or afford, that gives that spouse time to make some intelligent decisions on what they want to do with that home. Because if they lose the home, they not only lose the home, but they lose the $150,000 of equity. And that is the real death benefit, if you will, that the husband was trying to leave to the wife. She just needs time to access it. So I love how you put that. Good job.
Thanks, Shannon. Okay, well, thanks everyone for attending. And this is our 5th podcast in 2024 of It's Your Life. We will see you next week.